invest more if it's a good idea. When there is a sale in a shop, even if you want to buy one shirt, but if it says if you buy two, you get the third free, you come home with three, right? When the gold prices go down, you invariably are in a hurry to buy because you feel, arey, gold price upar chala jayega, to kya hoga? But when equity markets are down, you wait for the bottom, which nobody knows. So if you are on the good, strong footing, if you have not over leveraged, if you have invested adequately and your near-term goals are not getting impacted, please invest more. So the best way is to be greedy when others are fearful and be fearful when others are greedy. So today everyone is fearful. Please buy smartly. There's no hurry to buy tomorrow. Buy over 6-8 months. So, and do not get stressed. So take only as much dose as you can handle volatility.
Hello everyone, welcome to the next edition of ThisorThat. Today our guest is Shyamali Basu. She is a senior industry leader. She is currently an associate with Sapient Wealth Advisor. It's a leading financial advisory. She has over 30 years of experience in financial services, of which 22 years were with HDFC Mutual Fund, where she worked as executive vice president. She regularly contributes through her writing to simplify investing and wealth creation. Today we will cover how to manage our emotions during a fluctuating market, how to evaluate portfolio, how to construct portfolio, and how to get a goal orientation to our investing approach. So I welcome Ms. Shyamali Basu to the next edition of ThisorThat. Hi ma'am.
Hi.
Thank you very much for your time. We'll start with the current emotions of people. Market is fluctuating. People get stressed, portfolio gets into red. What is the right way to look at this? How should people manage their emotions in such markets?
Okay. First of all, thank you so much, Bharti, for inviting us. And I think it's a great thing that you're doing. There is so much available in social media, but very few handles where probably you can trust. And if you do a good job, all the best to you.
Thank you.
Okay. Market fluctuates, it always does. When does it not? Right? And people get worried only when there is a downward correction. Post-COVID, there was a 4-year upward swing, right? One way up, right? Nobody worried, right? So markets will always correct because that's the nature of equities. What should one do to manage their emotions? One is understand the nature of markets. So when you invest, you have various products you can invest in, right? And investment should cause no stress. Because if you get stressed, what's the point of investing? You're investing for your future. You're securing your family's future, your future, right? So it should give you peace of mind, right? And for that, there are various products you can choose from. You can choose from a fixed deposit which does not fluctuate, like a small saving scheme does not fluctuate. You can buy a bond which doesn't fluctuate if you were to hold it till maturity. But if you do all that, you're not happy with the returns, right? Because inflation being 7.5% over the last 30-40 years and the fixed deposits delivering 8% net of tax, you're actually earning lesser than inflation. When you're not happy with the returns, you want to venture out with a product which gives you higher return, right? So the steady investment which was giving you peace of mind is not good enough for you to create capital.
Correct.
So when you want to venture out to do something which will give you higher return for securing your future, you add a little of equity, right? Because equity is a volatile asset class. What you should do is to initiate your investments, first understand equity well, as to what the nature. So when you're buying an FD, you know the nature, right? You know the coupon, you know the maturity period. However, when you buy equity, you do not know how it behaves. You just buy because today, if you see 75% of the investors are newborn investors post-COVID. So they have jumped into this journey because of FOMO. Right? Because there's so much happening in and around you, when everyone is talking of equity markets and everyone is talking of making money the easy way, they've gone into it. But without understanding the nature of markets. Now, we have a history of markets from, say, BSE Sensex conception date 1979 to now. In 45 years, I think about 3 to 4 years, the markets have not corrected more than 10, They've corrected more than 10% in all of the years, 40 out of 45 years, right? So that's the nature of the market. Every 3 to 5 years, the markets correct 15 to 20%. And God forbid, any black swan event like COVID, they can even correct up to 50%. Now, those were the facts that one has to know before one starts investing, because only then would you know how much you can tolerate, you know. And if you have stepped it up and if you have started investing, and if you're young, it's a superb journey to start. Just this, that don't be overconfident and invest more than or bite more than what you can chew. Just don't do that, because then it'll hurt you, and don't get swayed. So how you can manage your emotions is, first, if you bought a good growing company which is going through a bad time because of the sentiments being poor, hold on, nothing to be done. However, if you bought some kachra companies because they don't even exist, perhaps just because the environment was very enticing, it's time to have a relook. So the best way to do equities to enhance your returns is to buy good growing companies or to buy a portfolio. Don't put in all your eggs in one basket, right? So I've come across investors who are overconfident about some company they don't know much about, just because it has done some 300, 400% kind of market pricing. That's not the way to take equities, right? So you take a portfolio, and if you are uninitiated, start with index funds, start with a portfolio of 30, 40 good companies, and then give it time. And when the market's correct, please invest more if it's a good idea. You know, when there is a sale in a shop, even if you want to buy one shirt, but if it says if you buy 2, you get the 3rd free, you come home with 3. Right? When the gold prices go down, you invariably are in a hurry to buy because you feel, arey, gold price upar chala jayega, to kya hoga? But when equity markets are down, you wait for the bottom, which nobody knows. So if you are on the good, strong footing, if you have not over leveraged, if you have invested adequately, and your near-term goals are not getting impacted, please invest more. So the best way is to be greedy when others are fearful, and be fearful when others are greedy. So today everyone is fearful. Please buy smartly. There's no hurry to buy tomorrow. Buy over 6-8 months. So, and do not get stressed. So take only as much dose as you can handle volatility. Right?
So what are the mistakes people do other than taking stress in such times that they should avoid?
Correct. So they say that what is the biggest factor that contributes for wealth creation? One would say one has to be good with math, a math genius, an intelligent guy. But the most important factor is your behavioral factor, right? You must have heard of the story of Sir Isaac Newton, who would say he's not an genius. Of course, his IQ was like 130. But he died a pauper. Why? Because he couldn't manage his investing emotions. So there was a stock called South Sea. And he invested, and it went up, and he was happy, and he sold. However, after he sold, he was very happy. He's made some quick buck. But what got him unhappy is his friends hadn't sold, and they continued to get rich. And then that FOMO came to him, and he invested whatever he had almost at the peak, and then it corrected, right? And he was a broke. So it's not the intelligence which is very important. It is your patience and your behavioral aspects which are very, very important. So I'll outline a couple. So one big behavioral bias is herd mentality, right? So in equity investing, what I have seen is that if you see a bus, right, headed somewhere, right, you're standing at the bus stop, and you see a very fancy bus, people are having a party there, maybe they're getting some freebies there, and you get so enticed that you jump into the bus, not realizing where the bus had started from and where it's terminating, right? Maybe those guys are about to get off, right, the next stop, but you've entered with all your money today. right? So sometimes people invest almost at the peak. So between you and I, if I tell you, Bhatin, this stock is damn good, you don't believe me. Shyamali doesn't know enough. But somehow subconsciously you keep tracking and the stock actually does well. And you hold on till you feel so jealous that you say, oh damn, I'm working as hard as Shyamali. How does she making money so easily? And you invest at that time when it's already expensive. And so herd mentality is something that you need to avoid. When you go to buy a fridge or a TV, you do so much research, right? You go to Vijay Sales, you go to whatever Reliance Retail, you ask some 20 questions, right? However, when you buy a stock, who do you rely on? Someone who's not even remotely involved with equity research, just because that someone has said he's made money, right? When we do investor meets, everyone says they've made money. Nobody says they've lost money. If they'd made as much money, would they spare time to come to listen to me? Answer is no, right? So herd mentality is one. Greed and fear we touched upon. So it's again, so they say these two emotions, so greed and fear, are very, very dominant and at extremely wrong timings. So when the markets were doing well, when I had also written and the world was writing about small and mid caps being very expensive, I had so many investors come and tell me, ma'am, you're very conservative, right? Why? Because people saw that large caps had not done well, mid and small had done well, and as a financial advisor or a distributor, I should do, or I should recommend things which have done well for the people, right? However, they did not evaluate that whatever has done well is far more expensive, and therefore it is not good for them to have it in their portfolio, right? So that is one. And fear. So when markets correct, and when I tell you, you top up your SIP, you will think twice. I've had one investor who said, okay, abhi dekhte hai, let it settle down, then I'll top up. Why? Because the markets are correcting. Till now, markets were going up. Right? You were accumulating fewer units with every higher NAV. Today is a chance after 4 years when I can actually top it up. But people are scared. And the last two things that I feel are also responsible for destruction of wealth creation processes. One is rear view mirror driving, because you see past returns, despite the big disclaimer that everyone writes that past returns are not a guarantee or an indication of future returns. And when you see past returns, what you do is you switch your lane. So any fund which is performing very well, you sell whatever you have and you invest entirely there. And in investing, everything changes, right? Your investing styles change, right? Your large, mid, small cycles change. The industries that are in prominence, they change. So winners keep changing. And when you have switched, you paid taxes and you move to something which has already done well because you've noticed it only after some time. And then again, you land up coming at the peak. So it's best to have a set process and stick to that. So if you avoid all these behavioral mistakes, these are all behavioral mistakes, they're not financial advice, then probably you will be able to get richer. So, if you didn't have a ticker of the price, and if you didn't have the ease of transaction, I'm telling you, we would have been richer.
इसमें मेरा एक सवाल है, हम बोलते हैं कि पास्ट रिटर्न नहीं देखना है, राइट? बट एक नॉर्मल इन्वेस्टर को रिटर्न्स के अलावा क्या देखना चाहिए फिर? अगर उसे कुछ म्यूचुअल फंड इवैल्यूएट करना है तो रिटर्न नहीं देख के क्या देखना चाहिए उसे?
रिटर्न तो बाय प्रोडक्ट है, राइट? हमको क्या देखते हैं? सो जब हम पोर्टफोलियो बनाते हैं, so return, of course, returns have to be consistent. Consistency of returns देखना चाहिए, right? You cannot be number one always, right? As long as you're above the median, you're good. So what is that you see? You see the track record of the fund manager. जब markets correct हुई हैं, तो उनका portfolio भी तो drawdown तो होगा, but if it is lesser or more, right? You see that. You see whether the portfolio is concentrated or not. And you will buy 3-4 funds, right? You will see the underlying portfolio के overlap कितना है. अगर हमने 2 schemes ली, which have the same theme, where have I diversified? Right? So you don't just see one in isolation. When you're seeing the portfolio, you will see various combinations so that one performs and the other doesn't perform should keep you happy. If all perform well, they will all fall also at the same time. So returns is a byproduct. You don't just select seeing returns. If you are just selected seeing returns, you would have had 100% of your money in small and mid only, right? So see a lot of things. You have to diversify the way we diversify across gold, debt, equity, fixed deposits, mutual funds. Even within mutual funds, diversify. So if large caps are not doing well, mid and small will take the return up. If mid is doing well, small and they are not doing well, it's okay. One of it will do well. So if you do that, तो सब number one नहीं हो सकते ना. So if you want all leaders, you will not be happy because in a portfolio of 5, you will have number 1, you will have number 5, right? So returns is not the criteria that should help you to select your schemes.
So ma'am, you have already touched a bit upon asset allocation, but if you can go in detail, what is asset allocation? How can people do asset allocation?
So if you study the attribution, आपके returns किस वजह से बनते हैं, ठीक है? जब हम और आप आम इन्वेस्टर बात करते हैं ना, तो मोस्टली द होल फोकस इज ऑन मार्केट अच्छी लगती है कि नहीं, अभी डालें कि नहीं, राइट? ओनली 10% ऑफ योर वेल्थ इज डिपेंडेंट ऑन दैट. 90% ऑफ योर वेल्थ दैट यू क्रिएट इज डिपेंडेंट ऑन व्हाट एसेट एलोकेशन यू हैव डन. एसेट एलोकेशन इज अ वेरी हाई फाई वर्ड, राइट? इसका मतलब क्या है? एसेट माने आपके पास जो 2-4 प्रोडक्ट्स हैं, एसेट बिकॉज दे विल क्रिएट वेल्थ फॉर यू, राइट? लायबिलिटी नहीं है, राइट? अब कौन कौन से प्रोडक्ट्स हैं मार्केट में जो आपके लिए वेल्थ क्रिएट कर सकते हैं? यू कैन बाय स्टॉक्स, राइट? इफ यू नो, यू कैन बाय म्यूचुअल फंड्स. म्यूचुअल फंड्स में तो आप बहुत वैरायटी ले सकते हैं. इक्विटी ले सकते हैं, हाइब्रिड ले सकते हैं, डेट ले सकते हैं. इवन विद इन इक्विटी, लार्ज, मिड, स्मॉल, वेरियस कॉम्बिनेशंस, राइट? यू कैन बाय अ फिक्स्ड डिपॉजिट, राइट? यू कैन बाय एनपीएस, यू कैन बाय a bond or a corporate FD, right? Gold, you can buy physical bars, you can buy an ETF, and you can buy a gold bond or a fund. SGBs band ho gaya, right? Now, when you and I both have 100 rupees, right? Now, what is asset allocation for me and you would be different, right? You are much younger than what I am, right? You want to create wealth. Your kid is much younger than my kid. My son is working. Yours is still studying. So you have to provide for his schooling, education, and you know that you can give it longer time, right? So when you choose out of that 100 rupees, you will put in, say, maybe 25, 30, 35 in equities. You will put in very little as your emergency cash or a FD. You will put in some bit. I think you will put more. I mean, the formula says 100 minus age, but it's not a sacrosanct formula because each one is different. In my case, I will say, okay, fine, now I've created my wealth, my son is working, so now it is just legacy. So I don't mind staying in equity, but each one is different. So asset allocation in simple words means कि आपके पास जितनी भी wealth है, how will you divide your wealth across different products? Because each product has its own qualities. FD करेंगे तो return steady होगा but कम मिलेगा. So if you do last 45 years की study, I think equity markets have delivered about 15.5-16% return. 15.8. Gold is about 10.6, 10.7, right? FD is about 8. So you know the returns, right? And no asset class is bad. Whatever suits you is what you buy, right? तो अगर आपको कैश फ्लोज चाहिए तो हम FD दे सकते हैं, मंथली विड्रॉल, राइट? अगर आपको लोअर वॉलेटिलिटी चाहिए, 3 साल तक पैसे नहीं टच करने, आपको मान लीजिए 3-4 साल बाद यू वांट टू बाय अ कार, यू कांट इन्वेस्ट इन इक्विटी, यू विल बाय अ हाइब्रिड इक्विटी एट बेस्ट, बिकॉज FD से तो आपका पैसा नहीं बनेगा. So depending on what your needs are, you will allocate your money in different pockets, and that is what asset allocation is.
एक और वर्ड जो हम कॉमनली यूज करते हैं, पोर्टफोलियो. ओके, सो 3 वर्ड्स इंडस्ट्री में यूज होते हैं, एसेट एलोकेशन, पोर्टफोलियो एंड डाइवर्सिफिकेशन. इन दिस कॉन्टेक्स्ट मैं अगर एक एग्जांपल लूं, there's a young couple who is starting their life, what should be their portfolio, and before you answer that, what is a portfolio, and for their portfolio, what could typical asset allocation should look like, for an example.
So portfolio is a combination of all assets, right? No asset can be analyzed in isolation.
Correct.
So when I sit with a client, he cannot tell me or she cannot tell me that scheme A is better, scheme B, C, D is not doing well. No, I am seeing a return. So when I am telling them that this portfolio will yield roughly this kind of return, so this is what you should expect. I will include FD returns, I will include PPF returns, I'll include everything. So that's the portfolio, right? You said portfolio, you said asset allocation, and you said diversification.
Correct.
Diversification simply means out of that 100 rupees, how much has gone into equity, debt, gold, real estate if you have, I do not know. And within equity, how much has gone into direct stocks maybe, a portfolio as in a couple of stocks, a bunch of stocks. Within that, whether it's gone to large cap companies, mid cap companies, small cap companies, within that, whether you've chosen active management, passive management. So there are various categories that you can look at. Everything put together is a portfolio.
Okay. So would it be right that you should have multiple portfolio for different goals, or you should have a consolidated one portfolio?
So portfolio will be one only.
Okay.
However, your investment products will be different for different goals.
Okay.
Right?
Okay.
So as you mentioned, if there is a newly married couple, okay, now and I am repeating at the cost of repetition, no two newly married couples will have the same portfolio.
Correct.
Okay. Now suppose there is a newly married couple, just as an example, they would want to purchase things, right? Gaadi kharidenge, fridge kharidenge, TV kharidenge, whatever they need for their household, right? They would also, now this generation, if they are endowed already, like parents ka ghar hai, then they spend on experiences. So they will plan for holidays. Holidays are a very big goal for newly married couples or young couples. And as they age, they realize that, okay, fine, they will have to plan a family. They will have to start thinking about those expenses. So newly married couple mostly spends money because they are acquiring assets, right? However, if you start, and they spend sensibly on certain items, and sometimes a lot of parting happens. So I don't quite remember which book it is, but there is a book where they say that in creating habits, if you decide to save as much as you go to spend, you know, when we do this for our clients, then that habit of saving starts getting developed when the couple is, when both are earning, they're both spending, living life king size. Okay. So if they start saving a small amount of their money, they can afford to save it in equities. Also, when both are working in volatile sectors, as in they don't know whether they'll have a continuity of job or not, they will have to put a part of their money, 6 months money or whatever, as an emergency corpus. If they are in steady jobs, comfortable jobs, then I think they should invest entirely in equity, having of course a little buffer for the rainy day. That's about it. So their portfolio should be largely equity.
So just like this, say people in their 40s, how will their asset allocation vary?
So normally I've seen, you know, when I used to work with HDFC, the realization that your kid is growing and the education expenses are going to be spiraling, some seriousness comes in terms of planning for their kids' education. Now most kids, in my times, there were very few vocations we could take, like CA, doctor, engineer, ban jao, lawyer, ban jao. But today there are plenty of options, right? And today, India is an aspirational India, right? Everyone wants to send their kids to IG, CSE, IB schools, which are expensive. And subsequently, they want to go abroad. That's expensive as well, okay? So around the age of 40, I've seen normally people get very serious about kids' education. But if the kid is, say, 4-5 years old, there's plenty of time. I think there are some solution-oriented funds in the industry. You can either choose that, or if you're disciplined, set up an equity, diversified equity fund for the kid. I think that compounds very well over 17-18 years. Other than that, I think today families are nuclear families. They're no longer joint families. If you're in your 40s, You also are nearing your retirement age. It's coming closer than what it was when you started your career. So it is important to consolidate your own retirement incomes. And then again, so longevity has increased, right? When we got independence, it was 35 years. Today it's about 74, 75. By the time you retire, it'll be 85, 90. So when you're in 40, again, you have to invest in equity because that money has to last longer, right? So keeping some contingency fund, emergency fund, I think mostly it'll be if I were to plan, it'll be diversified equity.
So just you mentioned also, so let's say people who are touching 50, looking to consolidate their portfolio, looking to retire, how should they move to debt? Should they move to debt, or how should they consolidate their portfolio and have asset allocation when they are moving to retirement?
So when you're inching towards retirement, I'm assuming you need cash flows, right? So if you need cash flows, then you can't. So either you have compounded your wealth to an extent that there's some bit of aberration in the markets doesn't bother you, you can withdraw. Otherwise, normally, you move to a hybrid fund, and there is a concept of systematic withdrawal. You start doing it. But there's no point moving into a debt fund way too early, because your lifestyle continues to, or you don't want to reduce the standard of living, right? So your lifestyle expenses will keep going up, and as you age, your medical expenses will catch up, right? So in India, medical expenses are double digit, mid-teens. Education is almost like mid-teen. Again, if you consider all these fancy courses that one wants to do. It makes sense to plan your cash flows in a way that you don't disturb 70-80% of your equity compounding. 20% you will have to plan so that you run your household budgets.
People are randomly collecting different investment products. People buy FDs, people buy different mutual funds. And you recently wrote an article about it also. Is that, the portfolio of people is a khichdi, okay? And there is another word that people use, balancing portfolio. So your article was, if I'm not wrong, why is my portfolio in a mess? Something like that.
So what happens is that we've come across many investor portfolios where so they invest randomly. Okay, so I've invested some money, and then somebody comes and says, "Ye NFO bahut acha hai." I put in some in there, and then third comes and fourth comes, and over years you just accumulate mindlessly, right? As per Peter Lynch, over diversification does not guarantee alpha or higher returns. Okay, so we've come across clients with almost 130, 140 schemes with a return or IRR of 8 and 8.5%, because each one is crisscrossing in terms of returns. So you don't have to do that. Now the problem in consolidation in such a case happens because if you switch, you pay capital gains tax.
Correct.
Right? Because if it's an older portfolio. However, you cannot, if you wait for that 1.25 capital gains or whatever, it will take years to consolidate. So normally what we've seen is that if you have some 150 schemes, some of them will just have 10, 15, 20,000 rupees. So at least start moving those. And then what we do typically is we see the broad themes that the client has invested in, right? They would have had some mindless debt, which is sitting in their portfolio for 10 years, they don't even know, because wo NFO aaya tha dal diya. They would have some international, they would have some large, mid, small sectors, they would have everything, right? So the plain core portfolio of having diversified equity funds, we would like to retain those, have some bit of international diversification, have some bit of low cost debt for emergency, and the rest over time switch out over time, because obviously you don't want so much of capital gains in 1 year. So over time, over 3, 4, 5 years, you consolidate to 5, 7 funds. That's about it. You need 4, 5 equity funds with lower overlap in the underlying portfolio, different styles. You need 1, 2 debt funds. And that's about it.
So ma'am, then having a goal for your investment will help, I think. so that people have correct portfolios. So can you talk a bit about how people can get a goal orientation to their investing?
So it's very important. So initially, when I used to think, why have goals? I mean, when I do a financial plan for a client, why should I be bothered about what he has to do? But it's extremely important because there's a behavioral finance concept called mental accounting. Okay. Now, just let me explain it to you differently. Suppose you're working and you have your PF. And suddenly your friends want to go to Goa. You run out of cash. Markets are down. You don't want to book a loss. Will you withdraw from your PF to go to Goa?
No, of course not.
Why?
Well, this is for my retirement.
That's why. So when you attach a purpose to your investment vehicle, you will not make it fungible. You will not use it loosely for anything. Right? What's happening in equities today? Because redemption is easy. Whenever there is a need, they redeem. However, if you attach a goal to an investment, you tend to stick with it. Right? So you can do pretty much children's planning or retirement planning in open-ended equity funds if you are disciplined. But why is there a need for solution-oriented category? So that you bring in that discipline. Right? So if I earmark money for different purposes, whenever there is a need, you will evaluate whether to take from this window or that. Right? Then you will prioritize that, okay, this is my kids' education, I cannot mess with it. However, this is emergency, I can take the money out from here. So because of this simple but scientific concept of mental accounting, we like to attach goals to investments, and also it gives us clarity. Now, if there is a goal which is to be achieved in 3 years, and if you don't tell us, we will invest all of it in the market, right? However, if you say, I need this money in 2 years or 3 years, I will think differently. And therefore, each financial planner, whenever you meet a client, it is good to have a goal assigned so that as an investor, you are more disciplined, and as a planner, one is more careful as to what one is talking or prescribing.
What is the process of getting a financial advisor? What does it cost for somebody to have a financial advisor?
You'll have to check with the RIA because there is a fee that they charge, but roughly about anywhere between 0.2 to 1% I'm not an RIA. I'm a distributor. Distributors get commission from the fund houses, so we don't charge the investor. It is not so. When you go to a doctor, you go to the doctor because you need the doctor, right? You don't haggle with the doctor about the fee, right? So if you give financial planning that kind of respect, the fee will be nominal. I mean, nothing comes free in life, right? You will have to check with the RIAs as to how much they charge, but
So more than the charge, ma'am, what I want to understand was all of this could be too much for someone. People can manage their funds, but distributors and financial advisors, wouldn't they help? Wouldn't it make sense for people?
Of course they would help. So, as I told you, you can learn it yourself. Okay? If you're smart, you can do it all yourself. However, a person like Isaac Newton was smart but couldn't manage emotions, right? Sometimes you need, and if you're in this profession, it's easy, in financial planning, investments. However, if you happen to be a doctor somewhere or a lawyer or a media person, where is the time to understand? All your focus is on earning more money, and you're reckless about where you're investing that money. So you need someone to guide. I am a strong believer in having a mentor. It helps. It makes your journey easy. And for that, whatever be the fee, one has to pay because that mentor is also doing it as a profession. Over time, if that mentor helps you to reduce one big mistake, he or she, their fee is more than covered up by just saving that mistake. So when we talk to our clients, we say that if that 100 rupee stock falls to 50 rupees, it's a 50% decline. But for that 50 to come to 100, which is your cost, it's a 100% hike, right? So good planners or good fund managers, their main focus is in trying to reduce errors. right? And I think that needs some bit of experience. And if you can get a distributor who you can trust, it's a role that you have to trust, right? If you can get an RIA or an advisor, it's pretty much worth the price that there is attached to that service.
Just before this, we were talking about portfolios and goals. So, what is the right time frame in which we should evaluate our portfolios? Or that's question number one. And secondly, how do we assess whether the goal for which we made the portfolio, is it lagging or we are reaching there?
If you go to someone who has planned your investments, that someone has to be conservative in estimates, right? You cannot assume 15-20% market return, because then you'll be saving much lesser to achieve your goal, right? So if you are realistic in your estimates, when we give estimates as to how much is required, right? When we are withdrawing money, if you have a lower discounting rate so that your corpus doesn't get eroded. So one is conservatism in making the plan. You be realistic, or maybe a notch lower than realism. Be a little more conservative. It's okay if you deliver extra, nobody complains. But if a person falls short, it sometimes becomes difficult to cope with the gap. A regular review helps, because it's a dynamic process. You know, when we start our journeys with our clients, somebody changes the job, somebody wants to buy a house, somebody is relocating. So life is dynamic. So whatever you've thought of, say 2 years ago, may need to undergo a review or a change. So there is a review done every 6 months.
So
However,
6 months is the period in which you should do it?
We do it.
Okay.
However, a review doesn't mean action. Review means this is what is happening. Is there anything that has changed in your life? This is what has changed in the markets. You're pretty much on course. You're not on course. We discuss. And then we will take calls. So if you do it regularly, you're not worried towards the end of the journey. You're viewing it at every stop. So every month we send statements to our clients. So that is when we review internally. However, every 6 months we write to our clients. Some of them don't wish to review. Some of them who do, we do a review every 6 months.
So you mentioned that people should have 3 to 5 funds in the portfolio. Okay. What are the top 4, 5 or 3, 4 categories of funds that they should be part of this 3, 5 funds in the portfolio? You know.
So we do it simple. We do diversified equity. We don't do sectors, right? Because the fund managers in diversified equities cover the sectors which are upcoming sectors. Because if you take a sector, timing becomes very difficult, because sectors also go through cycles. So when I'm making a core portfolio, you can take some bit of index, right? Normal TRI. You can take some bit of, at this juncture, we would like to give more large cap oriented schemes. That of course would change depending on market conditions. So take a flexi cap kind of a fund, where the fund manager has the capability of moving across market caps, maybe 1 or 2 mid caps, 1 or 3 or 4, small caps, because the canvas is much more. Or else take a multi cap and a flexi cap combination along with some bit in index. That's it. If you want a more conservative portfolio, then just take a hybrid fund. Take a multi-asset fund which has debt, equity, gold. Take a balanced advantage fund. That's it.
I was experimenting with some of the AI tools, and it's pretty easy to do your financial planning. You ask the right questions, you give the right question, it generates a good, nice plan. So my question to you is, with the technology, how would you place the distributors and the financial advisors versus the technology?
I don't know about these tools, but AI, if you Google, give them your problems, physical ailments, they'll give you medicines too, right? Yet you go to a doctor, right? Because you're talking of health. Here you're talking of something as serious as health, which is wealth. If you don't have wealth, you can't go to the doctor any which way, right? I'm sure these AI tools over time will get refined and get better. Obviously, because that's what science does and technology does. But this question was asked to Warren Buffett in one of the AGMs.
Okay.
Right? And they said artificial intelligence. So he says, I believe in real intelligence. Okay. And the problem here, why I would prefer talking to a person is because I can talk about my emotional state, right? During this time when I have had 2-3 new investors, they have called me and asked me, ma'am, should I pause the SIP? I have told them, no, do not pause. If there is a way you can be disciplined and your AI can guide you accordingly, fair enough. But when it comes to human interaction, I am old school. I prefer talking to a human being because in a conversation, you get to know a lot more. In an AI tool, you are punching in what you want to punch in, right? You don't always necessarily punch in some subconscious bias which you have, right? So for me, I feel talking to a person, whether it's an advisor, trusted advisor, friend who knows this investments or an RIA is better.
एक वो personal question है, being part of the industry, is that everybody you ask, okay, even the industry talks about SIP का number ये हो गया है, and any person you ask is going to say मैं SIP कर रहा हूँ, but do people know where the money is going? SIP is not the product. Okay.
True, it's a way of investing.
So how should people look at it? It's not that SIP karna is not the objective, right?
Okay. So in earlier days, we used to have something called a recurring deposit, right? So SIP is similar, but in equity markets mostly, right? It's become very easy. And the industry has done immense amount of work to propagate it, and it suits the salaried class because they earn every month, they save a bit every month, and therefore SIPs have become the buzzword, right? If you see today, we have 25,000-26,000 crores getting invested through SIPs in the industry every month. Okay. Now, most of them are invested mid and small and sector funds. Okay. Again, the reason for those are that you've seen the past returns or more NFOs have come in sector funds and therefore SIPs have got started, right? The first thing that you need to know is SIP किसमें की है? Diversified equity में आप करिए, large mid small में करिए, but सब में करिए. Don't do if you have $10,000, just don't put it in one fund, spread it over 2-3 different categories. More importantly than that, okay, top up your SIP. Okay, as you earn more every year, your expenses will go up, but your investment tends to remain the same, right? When your expenses go up, you've upgraded your lifestyle. However, your investments are the previous level. So continue to top up every year, right? And the third and the most important thing is that there's a lot of debate on SIPs and cheap assets, expensive assets. And when everyone commits to an SIP, people commit for a perpetual SIP, 30 saal. But the statistics shows that most people, the average asset, equity asset longevity in mutual fund is 2.5 years, right? So you've started the journey, but you don't want to go through the whole cycle because initially for the first 10-15 years, SIPs don't give you return at all. It's a compounding machine, right? It takes 10-15 years for that return to start showing visibly in your portfolio. So if you start an SIP, remember 2-3 things. One is it's a commitment for a long term because in a short term, SIP will not earn you enough at all. Okay. In fact, it may even give you negative or flat returns. Right? Secondly, please top it up. That if you just keep these 2 things and then don't do SIPs in everything that comes in, 2 or 3 SIPs across different diversified equity asset classes should suit your purpose. I think that is how one should look at SIPs as a concept.
So we'll try and do a rapid fire kind of thing with you. I have some questions I'll ask you. Between direct equity and equity mutual funds, what would you recommend?
If you are a newcomer and you've not done research, equity mutual funds, at least you have a band of analysts and seasoned, well-qualified fund managers doing that job. If you are good at direct equity and you do your own research and you are strong in that field, but I would prefer mutual funds for me.
should you reach out to a distributor, financial advisor, or do it yourself?
I need a mentor, I told you. So even with 30 years of experience, I find it difficult to handle volatility when I buy one stock. You know, that's my personal temperament. So I prefer having someone to guide me.
So emergency funds, what are the right 3-4 products that people should use to put their money for emergency funds?
So emergency funds, we normally say if it's like a 3-month kind of a buffer, ultra short funds which is 100% debt, or else equity savings as a category which has smaller allocation to equity. So if you want to keep an emergency fund for emergency which you don't foresee in the near future, then equity savings.
First equity fund category someone should select when they're starting their journey?
I think index
fund. One advice that's generally true in investment for all that you want to give?
Be patient. If you bought the right scheme, just be patient.
You already addressed it, but index funds or active funds?
Both. So we give both.
Now this is probably could give a slightly longer answer if you want. There are a lot of videos, internet, there are a lot of analysis on buying a house. Okay, but I think there is there is a huge emotional aspect that no one talks about. Okay, and I have this question. Imagine you are 65, 70-year-old. Would you want to be changing your house? You know, if you're in a rented house. So, do you want to cover the emotional aspect of buying a house?
So this is a very touchy topic. In fact, I've written an article also on this. Because in India, unfortunately, real estate is very expensive, at least in Bombay.
Correct.
Bombay is like extremely expensive. And if you land up buying a house, which everyone wants to, I mean, I would feel more secure having my own house. You realize that it becomes your largest asset in your all investment products, right? You're tied down for 30 years paying EMIs. And that asset is earning you nothing other than peace of mind, that you don't have to shift houses. So if you do an antiseptic study, right, whether a house rented or bought, rented scores marks. Because today your rental yield is 2.5-3%, right? You pay 2.5-3% rent for the value of the house that you live in. But not everything. As I said, emotions are very important in this journey of investment. So start small, I guess, buy a house if you wish to, but don't overcommit, so that there are couples who whatever they earn goes as an EMI. So then what about your rainy days? Now, if some emergency was to happen, they can't sell that house, right? So have enough. The older couples that I meet, earlier when equity culture was not as common or accepted, they have a problem of plenty. They have some 5 houses, right? And therefore, then they are maintaining them has become a problem. Their kids, most of them are not in India, you know, and their rental yields is 2.5%. So if you have way too many, then please consolidate. One, if you need to buy, I think if it gives you peace of mind, then you should buy. But don't overstretch yourself so that you compromise on your investing needs.
Another question that I have is that it's a good advice to start early. Okay. A lot of people are not able to do it. Okay, so when they start slightly late, okay, what should be their approach?
So you have to start early. Einstein has said compounding is the 8th wonder. If you don't give it time, you don't create wealth. Okay, as I told you just now, that for the first 10 years you will not even figure out what kind of extra returns you've got. Now we did one simulation. I don't remember the numbers exactly, but say person A and person B, one starts at 25 years of age, the other starts at 35. The total amount that they both invest is the same. So one starts with 10,000, however, the other starts with 15, but after 10 years. Okay. So the amount invested is the same, the equity returns are the same. However, the corpuses are 2x of the guy who started early. Capital invested is the same, but the result is 2 times more. Because what the first person has given it is 10 years extra. Okay. So you need to give it time, and therefore starting early and compounding works. Okay. Why are people not able to start early is a question that we talk to many millennials. Okay. Today you go on, so the way they spend their salaries, whatever, expenses, phones, rent, okay, for people who are not living in their own homes, housing expenses, living expenses, commute, etc. Now, if you just ask, that's what we done. It was quite an eye-opener. If we just ask them in 1 month how many times they eat out, party, okay? So they eat out, say, every weekend. They do a party because they have to de-stress themselves. Do you remember after 3 months as to where you ate and how much you spent?
No.
So you would now in a city like Bombay spend 2.5K per meal if you were to go out on a Saturday meal. So if you just sacrifice that 1 or 2 meals in a month and start saving. And saving is a habit, you know. It'll take you some time. Initially you will get to be nudged, you know, that is month ka dal do. But once you start seeing your portfolio grow, it gives you a kick of a different kind. Then you will be yourself driven to put in more money. Right? So the only piece of advice to the younger people is that you're far more endowed than what we were, because your parents would have done a heavyweight lifting. So start saving now, even if it is whatever 10, 15, 20%, and develop that habit of saving, and that works well.
Any final concluding remarks you would like to give for this conversation? We already have good food for thought, but any concluding remarks?
Start early, stay invested for a long time, diversify across asset classes. I like SIP because it diversifies across time periods. You're not timing the market, right? And just enjoy your life after doing that. That should take care of your retirement. Thank you so much, Bhartin, for having me over.